Today we are analyzing mortality tables and actuarial concepts specifically for the national portion of the life insurance exam. You must view these tables as the primary statistical tool used by insurance companies to predict the probability of death within a specific group of people over a certain period. On the exam, you will see these tables linked directly to the law of large numbers, which dictates that the larger the group being studied, the more accurate the predictions become for the entire group. Actuaries are the professionals who analyze this massive amount of data, including health statistics and historical mortality rates, to determine the appropriate premium amounts for various age groups. A common exam question will ask about the primary factors used to calculate life insurance premiums, and you need to remember the big three, which are mortality, interest, and expenses. Mortality refers to the rate of death within a group, and this is the starting point for any premium calculation. Interest is the money the insurer expects to earn on the premiums you pay, and because the insurer can invest your money, they actually subtract the expected interest from the mortality cost. This leads us to the concept of the net premium, which is mortality minus interest. The exam often tries to trip you up by asking if expenses are included in the net premium, and the answer is always no. Expenses, which are also called loading, include the costs of running the business, such as agent commissions and administrative overhead. When you take the net premium and add these expenses or loading, you finally arrive at the gross premium, which is the amount the policyholder actually pays. You can remember this with the phrase mortality minus interest is net and net plus loading is gross. Another critical area for the exam involves the different types of mortality tables, specifically select, ultimate, and composite tables. A select mortality table shows the death rate of people who have recently purchased life insurance and have just passed a medical exam. Because these individuals were recently screened, they generally show lower mortality rates than the general public. An ultimate mortality table, on the other hand, excludes these newly insured individuals and focuses on the death rates of those who have been insured for a longer period of time, where the initial health screening advantage has largely disappeared. You might also encounter composite tables which combine data for various groups, such as smokers and non-smokers, into a single average. When you are looking at these tables on the test, remember that age and gender are the two biggest drivers. Men typically have higher mortality rates than women of the same age, and the probability of death increases as a person gets older. If you see a question asking why a younger person pays less for life insurance, the answer is simply that mortality tables show they have a lower probability of dying in any given year compared to an older person. Watch out for trick wording regarding the accumulation of reserves. Actuaries use these mortality tables not just to set premiums, but also to ensure the company has enough money in reserve to pay future claims. A reserve is a liability on the insurance company's balance sheet because it represents money that must be paid out in the future. By mastering the relationship between mortality, interest, and expenses, and understanding how select and ultimate tables differ, you will be well prepared for any actuarial questions that come your way during the national exam.